Happy New Year, Maverick Traders. This is Rob Reinhold. This is the first edition of the Trading Room in 2025. Now, I love the end of the year because we get to basically close up the books for the year. Now, as traders, I also love this time because I love to remind everyone, no one cares, especially the market, what you did last year. If you had a great year, great, pat yourself on the back, great job. Guess what? No one cares. The market doesn't even know who you are. You better come ready to trade 2025. If you struggled last year, then guess what? Look back, look and see what you did wrong, learn from it, but then it's in the past. Turn the page, come into this year full of confidence. We have a full year of trading, so let's go ahead and get into it. In this session, we're going to be talking about the news of the week. We're going to be taking a look at all of our sectors. I am going to be adding in a new sector in our slots. So for the rest of the year, you're going to be hearing about our new sector. And of course, I've got setups for you. I'm not super keen on the market at the moment. It's giving us a 0. So I'm not looking to be super active right here, right now.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, let's start off with some news for the week. Again, it was a holiday shortened week, which means we did not have a whole bunch of news. So we had the market close on Wednesday, but we got a gap down on Monday. We had selling on Tuesday, we had selling on Thursday, and then we had a big rally on Friday. We'll take a look and see where we ended up, but I'm telling you right now, nothing really changed technically on a chart. We did see the US dollar end the year at highs. We saw the 10-year bond end at about 4.6%. Well, guess what? There was no rotation out of those assets the first week of the year. We saw the dollar creep higher and yields hold in really firmly. As I mentioned earlier, we didn't have a ton of reports here, but let's take a look at probably the biggest one was on Friday. We did get the ISM manufacturing report out of the US. And you can see here that it beat expectations. So it was supposed to come in at 48.2, came in at 49.3. So that's a nice jump. Remember, above 50 is expansion, below 50 is contraction. This number has been in contraction for 2 years. No one has really cared about it. But take a look at those prices. Those prices came in a little hot. This is just another reason why the Fed is less likely to give us more rate cuts. We're now down to 1 rate cut as projections in 2025. So let's check in on the final numbers of the market. And as you can see here, the final numbers of the market were basically fairly flat. We had the Dow down 0.5%, S&P down 0.5%, the Q is down 0.75%. Look at the Russell. Now, we've talked about the January effect the last 2 weeks. One of the things we talked about were underperforming sectors getting a bounce in January, and also small caps getting a bounce in January. I'll tell you right now, before we get into the sectors, we didn't get bounces in the underperforming sectors, at least this week. We'll keep an eye on it. But we did get a bounce in the small caps. So the small caps are outperforming here. Check out that move in oil. Oil having a big jump. And the energy sector is the only sector that got an upgrade this week in our scoring system. So what does this mean in the charts? Again, all of this commentary, all this chat is great. But really, did it change anything in the chart? And you can see the answer is not really. We closed at the 50-day moving average. Right at the 50-day moving average. We started the week above it. We gapped down on Monday, sold off Tuesday and Thursday, had a bounce back. And again, that's a nice candle of a bounce back on Friday. That is likely going to lead to probably a little bit more rally. Open at the low, close at the high. That tells you there's a lot of money coming in. So I think we do drift back up into this area between the moving averages. If we look at our key levels here, our key levels are going to be, let's call it 58.50, maybe even all the way down to 58.30. Somewhere in this range in here is going to be support. When we look at the upside, I see a little trend line coming down here. I'm looking at a couple ranges here. 58.30 on the downside and then probably about 59.75 on the upside. Somewhere right in here. These are the 2 points here, and really I could even go all the way up to 60.45 saying, hey, I need a new swing high before I say that this little downtrend is over. Here's the range. We're simply stuck right in the middle of the range. That means that there is no clear technicals here going on for the S&P. Now, if we go and take a look at stuff like the Qs, we can see that the Qs are looking a little bit healthier. They're looking a little healthier. We got this correction here, a lower low, but we held this low. If we got a break out of this level, pull back, held this level, then I could go back to being more bullish on the market. But until some of these levels break, looking at the Qs, I'm going to say, we got 531 on the upside, and then probably somewhere around 506, 507 on the downside. We are smack dab right in the middle of it. Again, nothing clear on technicals. Looking at the heat map for the week, we can see the energy was just green. It was just flat out green. And we can see a lot of red, but again, nothing real intense other than Apple had a really intense sell-off. Tesla had a big sell-off. They had some news that they missed deliveries, or they actually had less deliveries for the first time ever for a calendar year. Okay, so we had some selling, but it wasn't intense. There is nothing out there that's telling us to freak out. That being said, there's also nothing out there telling us to get super bullish. That's just where we are now. We have a very famous saying at Maverick, trade the market in front of you. Not the market you want it to be, not the market you think it should be. Just trade the market in front of you. And at the 52 weeks of the year that we do this trading room, there's going to be probably 5 to 10 where it's not clear, where there's no clear score, and we say, hey, you know what? We'll throw our hands in the air and we'll wait a week till we get a little bit more clarification on what's going on. I'm a little bit worried that this might actually be with us for the next couple weeks. So the outgoing president leaves on January 20th. The incoming president comes in on January 20th. And I think we're going to start to see some politics about what is going to happen, some of the changes. And I'm going to say this as even politically as I possibly can. There are some things that the market is very worried about that the new president and administration could tackle. And there are some things that they are very enthusiastic about that they could tackle. I think the big question is which one of those get implemented first, and frankly, which one of those can get implemented. Some of them may not even be able to be implemented with the votes they have in Congress. So that's where we are right now. We've got this threat of looming tariffs and possible threat of deportations that are generally seen as net negative for an economy. And then we have less regulations. We have lower taxes that are generally seen as positive. I think it's really going to come down to which one of those is most likely to get passed. That's why I think this market is probably in for a little bit of sideways here until we get some more clarity on that. The last thing I did want to talk about, we've talked about the January effect quite a bit, and I talked to some of our traders this week, and I think I gave the impression that the numbers say that the top 10% of stocks have huge sell-offs in January, and that's not what the numbers say. I'm going to get into the numbers here in just a little bit. This is simply the data says that for the only month during the year, the worst performing sectors over the past 6 months do better in January than the top 10%. In January, the top 10% still go higher. So it doesn't mean that the high flyers of 2024 are going to crash and then the worst stocks of 2024 are going to rally. No, they can both rally together. They can both rally. January is typically a very bullish month in the stock market. So I just wanted to clear that up here with the January effect. We are back to like a normal non-holiday week here. So we've got some news here. We have services PMI. That comes out on Tuesday, along with the JOLTS job openings. Then on Wednesday, we get ADP employment report and the Fed meeting minutes. And then on Friday, we get the December payrolls report. Expectations are for 150,000 jobs. That is like the perfect number. We are back in this Goldilocks scenario. We don't want it too hot. We don't want it too cold. We want it to be just right. This number, 150, 170,000 jobs, that's like the perfect number to where the Fed is going to say, oh, the labor market isn't too tight. Maybe we can cut. And it's strong enough for people to say, hey, this economy is still doing just fine. We'll watch that number on Friday, but just understand this number typically comes out the first Friday of the month, but with the holiday, we're now getting it on January 10th. Where does that leave us on our score? 0. Now look, I've got this shaded at a 0.5. If you take a look at the chart, we are, again, at the 50-day moving average, so that would be a 0. We are below the 20-day moving average, which would be -1, and then one slope is up, one slope is down. Technically, this is -1, but if you take a look at the NASDAQ, it is a +1. If you take a look at some of the other metrics, they're a -1. So I'm shading this as a 0 to -1. That being said, I am going to be scoring this as a 0. So when I do my allocations for my trades, if you want to do it as -1, knock yourself out. This is where, again, you can have a tiny bit of discretion when you are filling out your slots. Let's go ahead and score these sectors and see what happened this week. And I'll tell you right now, there wasn't a whole lot of movement. Before we jump into it, let's go into the January effect. I told you I wanted to talk about the numbers here. I talked about this last week, so I'm not going to get into the study, but I want to show you the raw numbers here. The raw numbers were that in January, the top performing stocks were at 3.4%, 3.4. The bottom 10 were at 4.95. So you can see this is still a very strong number. You can stay with the winners. They still have a very good month. It's just the bottom ones tend to have a little bit bigger bounces off the bottom. But you can see that for February through December, look at the massive outperformance of the top 10. So again, this P1 is the top 10%. Look at their performance here compared to this performance. It's just terrible. Look at the whole year long. You can see it is just glaring. But in January, you typically do get the bottom 10%, the weakest stocks, typically get a nice little bounce off the bottom. So look, as I said, it doesn't mean that January is negative. It doesn't mean that the top stocks in December or in the year before go negative. It's just that you get some decent bounces off the bottom. Let's go in and take a look at these sectors, and you're going to see a new sector has been added. I've had emails over the past year or two talk about, Rob, why don't we throw in consumer staples? One of my big complaints about the stock market for years, for decades actually, was that there was no consensus on what the sectors of the market were. Moody's said there was 9 sectors. S&P said there was 11 sectors. This company said there was 12 sectors, and they all broke it out individually. And they finally came up with a system. It's called the GCIS system, the sector scoring system that everyone has now adopted. And what they've done is they've said, okay, these are the sectors. Now, we've been doing sector analysis for decades, and consumer staples were always together. And in 2021, when they made this GCIS, they split them apart. And I looked at it and said, okay, we talked about it and said, all right, let's leave them out. We can use consumer staples when we trade consumer. Earlier this year, I made the decision, hey, let's go ahead and add this in. But whenever you make a change to your system, you must make sure you're not making it under duress, or hey, I want to have more slots to trade because I'm not able to find the trades I like. Those are always bad decisions to change your strategy somewhere just midstream because of it's not working or you want to have different choices. So I said, hey, at the first of the year, we're going to be adding in consumer staples. Here we are at the first of the year, and you can see we have added consumer staples to the board. We have one more sector we're going to be scoring every single week. This week, energy was on a tear, 3.4%. Oil was up about 6%. But outside of that, we saw a decent bounce out of real estate. There were 2 sectors that I was really watching this week. The 2 worst sectors of last year were healthcare. Healthcare has been abysmal, and you can see it outperformed the market a little bit. So healthcare did get a little bit of a bounce. But I was really looking at materials. If you take a look at a chart on materials, take a look at the December the materials had. They basically lost the whole year's gain in December. And I thought, if there is a candidate for the for the January effect, it's materials. And over the last 2 days, materials has been atrocious. So it's definitely not showing up in the materials sector. Other than that, you can see that, everything was down plus or minus very close to the market returns. Let's go ahead and score everything. We had utilities at -2 last week. It's maintained at a -2. You can see it has bounced up to the 50 or the 20-day moving average. If it goes above that, I think it can be upgraded, but until then, it's a -2. Just a bear rally at this point. Communication services was a +1 last week. It was right here, and you can see pretty disappointing price action, but we haven't broken down. It's trading between the moving averages, but this 20-period moving average is sloping downward now, so we had to go to a 0, but it's one of the stronger sectors still. The 0 is actually a strong sector at the moment. Real estate. It had a little bounce, but boy, that is nothing but low base price action. That stays in -3, so if you were encouraged by the real estate bounce, don't get too excited. Not a great pattern here. Here we have healthcare. Same thing. The one thing I do want to point out about healthcare is we did hold that low. So you can see we came down. That is the first sign of a possible bottom in healthcare. I'm not moving off of my -3, but if we do get up above that moving average, okay, then I can start to move it up to a -2 and -1, and then maybe the January effect will have a nice bounce. But at this point right here, I think it's too early to call that. Moving over to industrials. Just what I talked about, a positive with healthcare. Take a look at this one. We actually just made a lower low here. Really lousy bounce back, really lousy price action. It's at a -2. It's going to stay at a -2 until this moving average gets a little bit steeper, but this is one of the more negative patterns out there. We're actually down on the week. Here we have financials. Financials went negative, had a rally. We hit that moving average, but again, we did not make a lower low. Technically, that is saying maybe the bottom is in. It does not mean it's bullish whatsoever, but it's just telling us, okay, be a little bit less bearish. We are really close to those moving averages, so we're going to give this one a -1. Here we have consumer discretionary. So these are the things that people want to buy. You can see we've got this movement down. We bounce exactly where we should off the 50-day moving average. This was one of our strongest sectors at the end of last year. And if we can get a bounce up above this, pull back and run, that will be a signal that it's now ready to go long. But at this point, it's a +1. But +1 makes it the strongest sector at the moment. Moving into consumer staples. That was the things people want to buy. These are the things that people need to buy. And you can see this is pretty bad price action. Fell down, rallied, came down, and look, this was negative on Friday. This was a -3. This is going to stay a -3. This is one of the more bearish patterns out there in the sectors. Moving into technology. We had some resistance up here. We've got some support. You can see that we are basically going sideways. So it's no surprise that this gets a 0. We're between the two moving averages. But I do want to point out that's a nice bounce on Friday. Much better than some of the other patterns we saw. I don't see any reason why we don't have a little bit more follow through. Do we get all the way up to this point? Probably not. But we are definitely range bound here to 0. But 0 is one of the stronger stocks out there. Here is the chart for materials, and hopefully you can see what I was talking about. I mean, this is just abysmal. A big fall, a base. And then you can see we actually had it even lower this week. This is not showing any signs of the January effect. Take a look at that volume on the last 2 days. People are bailing on this. So look, I'm not saying the January effect isn't going to happen, but it's not happening right now on the materials sector. You cannot look at this chart and say, oh, I think that rotation is coming into materials. That is not happening whatsoever. We have to wait for it to show up in the chart. And here we have waiting for it to show up in the chart. Energy had that same big fall, but take a look at the price action. It is totally different price action off the bottom, mostly green candles. This is the only sector to get upgraded this week from a -3 to a -2. If it can move a little higher, we'll go to -1, 0. I do like this sector as far as the rotation here on the January effect. Here's where we were last week. The only sector to get an upgrade was the energy sector. And our three strongest sectors, well, they all got downgraded. But look, they're still the strongest sectors. Tech, comm services, and consumer discretionary are still the strongest sectors. So let's take a look and see where our slots are. We had 4 trades roll off. We had a sideways trade on PCG and a sideways trade on 3M. Both of these trades were mildly to moderately profitable. We had a comm services trade on GJT that was a max loss, and we had an LLY bear on healthcare that was also a max loss. So we actually had a loss on expiring positions this week, but that's what happens with this system. This only leaves us with 4 current trades on, and I talked about this last week. When I don't have clear signals from the overall market, I put on less trades. I just have less capital out there. And then when I get to, +2s, +3s, I'm very happy to put out a lot of capital. But right here, right now, I'm very happy just to hang out. As I said earlier, I'm going to score this a 0. If you want to score this a -1, that's fine. I'm just going to be at a 0 here until something breaks out to the upside or downside. That means that I've got some slots to fill. As you can see, we have now added our consumer staples line. We now have one more sector to choose from. I'm not going to be real active, as I said. The great thing about this slots is at this point you have some discretion. I don't have to put on a +2 trade. I don't have to. I don't have to put on a -2 trade. I just don't have to. I can be all these things in the middle, and I don't have to put on all my trades. At this point, I'm just looking to put on sideways in utilities. I'll do a slightly bullish trade in common services. I'll do a slightly bearish trade in industrials that I do like to the downside. And I'm going to take a sideways trade in consumer staples. That's it. Hopefully everyone can see the evolution is that, when we were bullish, we were, putting on more bullish trades than bearish trades. We haven't really seen any bearishness here for the last, 6 months at least. But when things aren't clear, we just keep things right in the middle. We're not asking our trades to do all that much. So let's go ahead and take a look at some potential trades in those sectors to fill those slots. In utilities, I like the timing in utilities. One of the downsides of utilities is that most of the stocks only have monthly options. We're 2 weeks out from January monthly options, so basically I can choose any option I want if I'm willing to do a 2-week trade. We just had a trade on PCG roll off on a sideways that was profitable, so let's stick with that PPL on the sideways. Now this stock really is trading between these levels here. So let's call it low 31s, 31.20, all the way up to 33.30. That's really the range here, but we have to pick our midpoint. Remember, on our butterflies, we got to say, okay, is it going to be 32 or is it going to be 33? I'm going to pick 32 because I think the range is closer down here. So I'm looking to do the 31.33 butterfly. 2 weeks out. So 32 is going to be that perfect point. So I do not want it to break down below this support. And I do not really want it to take off and go above this resistance here. 32 is going to be the sweet spot. 2 weeks out on this butterfly. There is no other weekly options available. So this is really the only trade you can make on a sideways on PPL. If you don't like this one, there's other utilities out there that you can play. All right, going into comm services. It did get downgraded, but it's still one of the stronger sectors, and it came across as roadblocks. Any of you with young kids, you know what this is. My kids are too old. I know it is because I've got some nieces and nephews. This is simply just Minecraft on steroids for kids. It doesn't matter what it is. Beautiful, beautiful high base. And I love when things come down, touch the bottom of the high base, and they start to bounce. I don't know if this is the one that breaks it out and makes it run. I have no idea. Here's what I do know. It's very highly likely to stay in this range or break out in the near term. So this is where there's two strategies I love. Diagonal call spread. It's going to be go out 3 weeks by the 57, sell the January 61. That's basically slightly above where it is right now, giving you a beautiful, beautiful high percentage chance of making a profit on this. Or you could just do a bull call spread. So again, the 60-61 looking at it 1 week. This is going to cost you about 55 cents. So that's just under a 1-to-1 risk reward here on that trade. If you want to get more bullish, I like the trade. If you want to lean more bullish, then I think this 60-63, give it 2 more weeks, bull call spread, looks really good on Roblox. Moving on to industrials. This is the one I want to be short or bearish in. Came across UPS. UPS has been stair-stepping down. Rally, bear rally. Look at this beautiful engulfing candle. Gapped up and then tanked. And then this is what I really liked about this stock chart. Not a bounce today. The rest of the market was up big on Friday. This one was down. If we take a look at where a potential target is this trend line maybe down to the 119 area, 118. I am not that bearish. I'm looking at a -1 trade, so I'm looking to be mildly bearish. I'm looking at a 125, 122 bear put spread. It's going to get me the deltas I'm looking for. All I need is a trade that goes to 122 or lower for a max gain. If you want to be more bearish, I think you can go down to the 120, 125. Just give it a little bit more time to get there. That's bearish in industrials. And then our new sector, consumer staples, the things people have to buy. Here we have Monster Energy Beverage. So Monster Energy Beverage, I'm looking to do a zero trade, so I'm looking to be sideways. As always, we need to pick where our midpoint is. This stock is trading really between, the $50.50 all the way up to, let's call it the $53.50 area. I'm looking to be slightly bearish here, so I like the 52 midpoint. So I'm going to be looking at the 51, 52, 53 butterfly just for 1 week. So it's going to be pretty tight, but it's only 1 week. Basically saying I think it closes inside this window here. And again, our profit area is probably right in here. These are closed pretty tight into here, so I'm slightly bearish here on this. I do think this one does start to go down a little bit over the next couple weeks. So if you want to look for something a little bit bearish, I don't mind this at all off of a bear rally pattern, making its way down to the 51. But I'm going to be doing it as a slightly bearish butterfly just for 1 week out. All right, let's go ahead and wrap this up. There is no technical direction right now to this market. Anyone who tells you they know where this market is going, well, we all have our opinions. That's it. I could give you my opinion, but it doesn't really matter because the technicals are what we trade. And the technicals right now are very mixed. We don't really know where this market is going yet. When that happens, we can scale down. Again, we scale everything down. We make less trades. We do closer trades to at the money. We just don't ask things to run as much. We try to get some positive theta that works for us during these moments. As long as things, don't take off and run, that positive theta is really going to come in and help your profitability out. When we do finally get the move, we'll make the adjustment. But until then, we really are just happy to trade the market in front of us. And right now it's telling us there's no clear signal. Thank you so much for the first trading room in 2025. Looking forward to more. Goodbye, everybody.